Have you heard about LEAP's options trading strategies and wonder what they are and how they work? Or maybe you found this after watching another video about LEAP's options, or just trading in general and wanted something more, maybe something that made more sense to you. One of our channel's viewers, Carolyn, went ahead and emailed me and she asked me about making a video about LEAP's options. So here you are, and I hope you like it enough to give me a thumbs up on the video by the end. In this video, I'm going to go over 2 LEAP's options trading strategies: buying deep in the money LEAP's calls and selling deep out of the money LEAP's puts. And I'm going to do my best to explain it in a way that's as easy as possible. In a way that even my grandmother could understand it. Well, that's the plan. I'm also going to show you how you can scan for LEAP's options opportunities using a powerful scanning tool that you've probably never heard of. So stick around so you can follow along as I find some good LEAP's options to buy or sell. Also, in the description below, there's a list of chapters. So if I start talking about something that you already know about, well, don't hesitate to go ahead and skip to the next chapter. Before I begin, I wanted to let you know that I've been buying and selling stocks and options for more than 20 years. Also, I'm not a licensed financial advisor, and nothing in the video is a suggestion to buy or sell. Rather, I'll be discussing LEAP's options trading strategies, and they're for informational purposes only. So you can go out and do the research on your own, and then make up your own mind. Okay, so without further delay, let's leap right in and get started. Get it? Leap right in? Okay. So LEAP's options stand for long-term equity anticipation securities. And I guess somebody slipped in the P in anticipation. Otherwise, they wouldn't be LEAP's options, they'd rather be Lee's, and that just doesn't really sound that good at all. Seriously though, what makes a LEAP's option a LEAP's option? Well, a LEAP's option is just a call or a put option with an expiration date far in the future. And some say a minimum of 9 months, and others say more than a year. Either way, LEAP's options expire far in the future, and some LEAP's options expire as far as 3 years out. And the trading strategies for LEAP's options vary considerably when we're talking about an expiration date so far into the future. For example, with the SPY, the S&P 500 Index ETF, there are LEAP's options that expire more than 3 years out. Now, you might be wondering, why would I want to buy or sell a LEAP option so far in the future? Why not sell one that expires this week or next month? Well, the further out you buy a call or sell a put, the higher the chance you'll profit. And the key to trading options is to tilt the chances in your favor. Now, for the purposes of this video, I'll be talking a lot about the SPY, or the S&P 500 ETF. But there's nothing stopping you from considering other companies like Apple, Google, Tesla, or any other quality company that you'd like to own. And also, I'll assume you're looking to take a bullish stance on your investing strategy. In other words, you expect the underlying stock or equity to go up. Now, if you think stocks are going down, stop this video right now because this one is not for you. Now, you can buy and sell LEAP's options on virtually any stock. And the best investors will say, if you're going to buy or sell options, do so only on the best stocks. The ones you'd be happy to own, not on something you heard of in a Reddit group or some strange YOLO feed that talks about stonks and tendies. Now, not that it's all bad, it's just far too risky, like the casino. And for me, when it comes to investing, I'd rather have the odds in my favor, wouldn't you? And that's exactly what LEAP's options offer. All right, so at the top, we've got call options and put options. Investors can buy and sell calls and puts, and they do daily. Call options give the buyer the right, but not the obligation, to buy 100 shares of the underlying security times the number of contracts at a set price at any time until expiration. For example, let's consider the SPY ETF. It's probably the most common ETF that tracks the S&P 500 index. If, as part of your LEAPS options trading strategy, you bought one SPY call with a $400 strike price that expires, let's say, December 9th, you could exercise your option at any time until December 9th and buy 100 shares of SPY for $400 a piece. The nice thing about it is that exercising is optional, because in this trade, you'd have $50 of intrinsic value. And if there's still time before expiration, well, you could just sell your option and make even more. Now, you might also be wondering about selling LEAPS put options. Selling out of the money put options is another bullish strategy, and it's an amazing way to generate income because the risk is essentially the same as owning a stock. Put options offer buyers the right, but not the obligation, to sell 100 shares of the underlying stock or equity, times the number of contracts at any point until expiration to the contract holder or you, the put seller. In other words, the person who bought your put option could make you buy 100 shares of the underlying stock from him or her, times the number of contracts at the strike price at any time before expiration. Taking the same example from before, let's say you sold an out-of-the-money SPY LEAPS put option with a $300 strike and with a December 9th expiration. And for that, you collected $21 in option premium. And on expiration, SPY is trading below the strike price at, let's say, $290. Well, you can expect to be put 100 of SPY for $300 a piece, even though they're only worth $290. And in this case, your P&L would look like this. $21 minus 300 plus 290, and that gives you $11 of profit. And to that, you multiply by 100 shares, and you get a final profit amount of $1,100. Not bad. Now, if the underlying security moves further below the strike and becomes in the money, well, you can always roll the option over to a lower strike price and further out. And traders roll options by issuing a buy-to-close order on their put option, and then sell another option with a lower strike price. Now, you might wonder, why do people buy put options? Well, the reason why traders buy LEAPS put options is to protect themselves against potential losses. But since stock markets usually go up, you can use this to your advantage. In fact, traders will make the most money with this LEAPS strategy if they sell put options when volatility is high, as it was back in March and April of 2020. Okay, so when it comes to LEAPS call options, investors typically gravitate towards deep in-the-money LEAPS call options. This way, they get the ability to control 100 shares of the underlying security per contract for a lot less money than owning the underlying stocks or equity outright. And what boggles my mind is that in many cases, deep in-the-money LEAPS call options, like those with an 80 or 90 delta, will cost about half as much as owning the stock outright, with very little extrinsic cost. Now, one thing that's amazing about this strategy, buying deep in-the-money LEAPS call options, is that your downside is limited to what you paid for the option. In other words, you can't lose more than you paid for the option. For example, let's take SPY again. Say Alex, the investor, buys 100 shares of SPY for $400 a piece. Well, that's a $40,000 outlay. And then let's take Logan, another investor, who decides to buy a deep-in-the-money Leaps call option on the same SPY with a $200 strike and an expiration 3 years out. The premium for this is $210. In this example, Logan gets to control 100 shares of the SPY for $21,000. Now, in this case, because Logan bought a $200 strike, he gets some downside protection. Because if the SPY goes below $200 at expiration, which is highly unlikely in today's market, but if it does, his loss is limited to what he paid for the option, $21,000. But Alex, on the other hand, well, his losses don't necessarily end there. If the SPY went below 200, well, Alex could stand to lose a lot more. Like if the SPY went to 150, well, Alex's losses would be $25,000. And if it went down to $100, the loss would be $30,000. So by buying a Leaps call option, Logan gets to participate in all the upside of the SPY over and above the $200 strike price, just like Alex. But Logan paid a little under half, and he gets all the downside protection. Alex, on the other hand, got 100 shares and paid full price. So who would you rather be, Alex or Logan? Let me know in the comments below and why. It's natural to wonder what stocks should be part of your Leaps options trading strategy. For bullish strategies, such as buying Leaps calls or selling Leaps puts, the key is to buy and sell options only on quality stocks and ETFs. Investors who buy Leaps call options on poorly chosen companies could end up losing all of their money if the company goes to zero. And similarly, investors who sell Leaps put options could end up underwater if the stock or ETF fell far below the put option strike price. Remember, buying Leaps calls and selling Leaps puts are bullish strategies, so we as traders want the underlying securities to go up. So what are the best underlying equities to invest in? Well, I like to start with the dividend aristocrats and dividend kings. These are companies who have not only paid a dividend for, well, in many cases, well before I was born, but they've also increased their dividends consistently every year for decades. These are companies like McDonald's, who have more than 39,000 locations in more than 100 countries. Or Procter & Gamble, who sells products like Gillette, Tide, Charmin, Crest, Pampers, Febreze, and so on and so on. When I'm researching these companies, I like to first check suredividend.com. This is a site I use daily, where I can read up on the latest updates on dividend stocks. And the Sure Dividend newsletter, well, that's their flagship product. It sends me monthly buy and sell updates from their 700 dividend stocks that they track. And by the way, if you'd like to support the channel and maybe save a bit of money on their newsletter, go ahead and check the description for a link because I've given you a link for Sure Dividend and a promo code. Aside from the dividend stocks, you can also buy Leaps call options and sell Leaps put options on index ETFs like the SPY. And since it's an ETF that tracks the S&P 500 index, it actually holds the same 500 stocks on the index. So there's always tons of liquidity available. But knowing the companies I like to buy call options or sell put options on is just half the battle. And for this, I like to use Option Samurai. So here we are on optionsamurai.com. If you don't already have an account, you can go ahead and hit Start Here for free. Or if you'd like to support the channel, you can go ahead and click the link in the description below, and you'll also get a discount. So I'm going to go ahead and hit Log In, and this automatically logs into my account. And I've already set up a predefined scan for Leaps options. So I'm going to go ahead and hit this. Now remember, Option Samurai is kind of like a search engine for options. And what I've done in this particular case is I've set up a long call, so a Leaps call option with over 600 days to expiration and an 85 delta or higher, where the strike price is below 15% of the stock price. And here's our results. So it's got a bunch right here. And the number one result is the SPY. And what do we have here? It tells us the current price of the SPY. The trading price is $459.83. The call option in particular is the $340 strike price that expires in 809 days. And this one has a delta of 89.09 and a break even of 3.84%. So what does this all mean? Well, the break even means it has to go up the SPY would have to go up 3.84% in order for you to be profitable. That's it. Sometime between now and in 809 days. That is incredible. The delta of 89.909 means that for every dollar that the SPY goes up or down, the call option price will go up or down by 89.909 cents. And the expiration, well, this is 809 days into the future, and $340 is the strike price. And again, all we want is for the stocks to go up, and the further they go up, the more money you make. So let's take a look and see the cost of this particular option. And here we see that we have a midpoint of $135. Now, the bid price is what traders are willing to pay for this particular option, and the ask price is currently what option sellers are willing to sell for. What I find is by putting in a limit price of the midpoint, which in this case is $135, it gives me the best chances of, number one, saving a bit of money, and number two, actually getting a fill. So that's this particular option. Now, as you can see, we have other option opportunities. For example, this one you can do a call option on the NASDAQ 100 or on QQQ, or you can even get 100 delta on these, or on this one here, BlackRock. Look at this one actually here on BlackRock. This one has a $420 strike price, which is over 55% less than the current trading price of the stock itself. In other words, you can get a dollar for dollar movement in your call option for less than half the price of owning the shares itself. So this is really incredible. And look at the break even on this, 0.61%. So this is Option Samurai. And if you want to know more about Option Samurai, I went ahead and left a link and a promo code in the description below. So far, I've mentioned options moneyness a few times. For example, in the money and out of the money, but what does it mean? Well, regardless of the LEAPS option strategies that you invest in, you'll need to know the difference between in the money, at the money, and out of the money. Knowing the difference between these will help you make better decisions when buying and selling options. Let's start with in the money options. An in the money option means that the option has intrinsic value. It's actually worth something. Intrinsic value is the difference between the underlying equity and the strike price. For call options, in the money means that the underlying equity trades above the call option strike price. For example, let's take the SPY and say it's trading at $400. With a call option, any strike price under $400 is in the money. Put options are the opposite. So let's say if the SPY trades below the strike price, then it's in the money. Next, we have at the money options, and these have little to no intrinsic value. For both call and put options, at the money options have a strike price around the underlying security's price. Again, taking from the SPY, an at the money strike would be around $400 because the ETF trades at $400. And for all you option sellers out there that want your option to expire out of the money, simply just need to know that call options, out of the money means the underlying security trades below the strike price. And for put options, it means the underlying security trades above the strike price. And when an option expires out of the money, it expires worthless, which is perfect for option sellers because they get to keep all the income. After some time, you may have noticed that your LEAP's call options might be worth significantly more than you paid for it. It's not unheard of to have the option worth double or even triple what you paid for before expiration. And similarly, for put options, it's not unheard of that the option price plummets and presents you with an opportunity to buy it back for pennies on the dollar. But you might be wondering about liquidity. In either of those cases, if you're in a profit position, like when the call option will be far in the money or if the put option is far out of the money, well, in this case, you may not be able to find someone to buy your call option. And similarly, there may be no one selling the put option you need to buy to close out your trade. Remember, only the buyer can exercise their rights in option contracts. So if you're a LEAP's call option holder, you can exercise your rights and call the options. And to exercise your call options, you'll need to notify your brokerage, or you may even be able to do it in your online trading account. And when you exercise, remember, you'll be buying 100 of the underlying equity times the number of contracts for the strike price, which in your case will be significantly lower than the current trading price. You're going to be getting the stock or the underlying security at a huge discount. And then you can sell them back to the market for a profit. And the profit will be the difference between what you paid, the strike price, and the current trading price. For example, let's say you bought a LEAP's call option on the SPY with a $300 strike price, and today the SPY is trading for $400. Well, you can exercise your right as a call option holder to buy 100 shares of the SPY for $300 a piece. That's the strike price. And then you just sell them back at the market for $400 a piece, which is the current trading price. And the difference is your profit. Now, if you sold a put option, this is a little bit different. You've already collected the option premium. That's the income you earned from selling the put option. And your goal as a put option seller is for it to expire worthless. But if you want to close out your trade, you're going to need to buy the put option back. And to do this, you need to check the latest bid-ask prices and be careful to set a limit order to buy back these options. And setting a limit order limits the price you're going to pay, because if you set a market order, well, you could end up paying so much more for the option than you need to do. So set a limit on the amount you're happy with. Okay, so when it comes to LEAP's put options, investors typically sell deep out of the money LEAP's put options. It's also known as a naked put or a cash secured put. Either way, it's a bullish bet with no more risk than owning a stock. What's amazing about this strategy is that you can sell deep out of the money put options with 70 or 80% chances of expiring worthless and collecting some hefty income along the way. For example, let's take the SPY again. Say Alex, the investor, sells one SPY LEAP's put option with a $300 strike that expires in 3 years. And he collects $14 for the option. That's income that Alex gets to keep. Now, in this case, because Alex sold the $300 strike, he's in good shape as long as the SPY stays above 300. And if it does at expiration, he gets to keep the income. Now, if the SPY goes below $300 at expiration, Alex can also roll his option to a future expiry and recover some or all of his losses. Next, we need to consider intrinsic versus extrinsic value. Intrinsic value is the difference between the current stock price and the strike price, or how much in the money the LEAP's call option is. Let's use some real numbers. At the time of this recording, the SPY is trading for $457.89. If you have a LEAP's call option with a $400 strike price, then there's $57.89 of intrinsic value. And if the strike is 210, well then there's $247.89 of intrinsic value. But that's not all. We also have extrinsic value. And calculating extrinsic value is incredibly important so that you know how much premium you're paying to get into your LEAP's option trading strategy. We as traders want to pay as little extrinsic value as possible. You can calculate extrinsic value like this. We take the underlying security value, say the SPY at $457.89. Consider the LEAP's call option strike price, let's say $210, and to calculate extrinsic value, we have to consider the cost of the option. So let's consider the LEAP's call option current value, or the asking price. Today it's $250. Extrinsic value is the underlying security minus the strike minus the call option's current value, or also known as the premium. So in this case, the extrinsic value is just $2.11. Just $2.11. And all that to control 100 shares of an underlying security that expires so far into the future. Investors calculate returns based on the crystallized amount they receive from their LEAP's option, divided by what they originally paid. Taking from the above example, let's consider Alex and Logan once again. And we'll make up some round numbers to keep it simple for everyone. Remember, Alex bought 100 shares of the SPY for $400 apiece for a total of $40,000. And Logan decided to engage in a LEAP's option strategy and bought a call option with a $200 strike price, deep in the money, expiring 3 years in the future. And for this, he paid $210 for it. This strike also has a 90 delta, which is represented as 0.9 on your trading platform, meaning for every dollar the SPY goes up, the call option will go up 90 cents. Now, fast forward 30 days, and let's say the SPY had a good month, and it went up 4%. Now the SPY is trading for $416. Well, the call option with its 90 delta means it's going to go up $14.40, and here's how we calculate it. We take the 0.9 and multiply that by the $16 that SPY went up, and we get $14.40, and then we add that to the cost of the option, which was $210. And that means the option will theoretically be worth $224.40. Now, one thing we didn't note was theta. For deep in the money LEAP's call options, theta is going to be minimal, and I'll get to that in a little bit. But for this example, to calculate the returns, Alex returned is $41,600 divided by 40,000, or 4%. Logan's return, however, is calculated as 22,440 divided by 21,000, and he got 6.9%. Putting it differently, Logan got 72.5% more profit than Alex. And if we look at it on an annualized return, Logan would have more than 116% annual return in just 1 month. And folks, that's the power of LEAP options. Okay, so far in the video, I've mentioned delta a few times, and once or twice I may have added theta. When putting together a LEAP's option strategy, it's important to know the Greeks because, one, most people don't, and because of it, it'll give you an edge over the rest. All right, so let's start with delta. Delta tells us how much the option price will go up or down based on every $1 change in the underlying security. Delta is usually given to us in the form of a decimal, like 0.35 or 0.8 or 0.9. And if you're looking at a LEAP's call, for instance, one that has an 80 delta, well, it's going to be expressed as 0.8. Then it means for every dollar that the underlying security goes up, the option will increase in value by 80 cents. And yes, if the underlying goes down $1, then the option goes down 80 cents. Delta also tells us approximately the chances it will expire with or without value. So a LEAPS option with an 80 delta tells us that there's about an 80% chance that the call option will expire in the money or with some value. Putting it differently, an 80 delta means there's about a 20% chance that the call option will expire worthless. And a 90 delta means that there's about a 10% chance that it'll expire worthless. Next, we have theta. Theta tells us how much the option will lose in value every day, assuming the underlying security doesn't change in price. Theta is expressed as a negative number since it's the amount the option will lose in value every day. So let's say you have a theta of minus 0.10. That means the call option is going to go down in price 10 cents a day as long as the underlying security doesn't change in price, but it will. So delta and theta go hand in hand. And as a result, options with a shorter expiry will have higher theta value than LEAPS options that expire further out. Next, we have Vega. Vega measures an option's sensitivity to implied volatility. Vega tells us the change in the option price for a 1-point change in implied volatility. And options are more expensive when volatility is high. And just like when volatility is low, option prices go down. So let's say, for example, you're considering a LEAPS options strategy and you want to buy a LEAPS call and the option costs $100 and its implied volatility is 20 and maybe it has a Vega of 0.12. Well, then implied volatility goes up from 20 to 22, so it's a 2-point increase. To calculate Vega, multiply Vega by the difference in volatility, and that's the amount you add to the call option price. Complicated? Well, okay. So in this case, the option price will increase 24 cents to $100.24 because 0.12, the Vega, times 2, the difference in volatility, is 24 cents. And as you may have guessed, with LEAPS options, because they expire so far into the future, volatility will affect them far more than options that have a nearer expiry. All right, so next we have gamma. Gamma tells us the rate of change between the option's delta and the underlying security's price. Higher gamma tells us that the delta could change a lot, even with a minimal change in the underlying security's price. So, if you're buying a call, higher gamma means the price of the call option will increase if the underlying security goes up. Now, if your LEAPS options trading strategy is to buy deep in the money LEAPS options, gamma isn't all that important because it's going to be a really low number. Gamma is important for at the money or out of the money options because if the stock moves just a little and the option is out of the money, then it loses all of its intrinsic value. And last but not least, we have Rho. Rho tells us the LEAPS call option sensitivity against changes in the risk-free interest rate. And that's the interest rate paid on treasury bills. Rho is expressed as an amount of money an option will lose or gain with a 1% change in interest rates. Now, because LEAPS options have a long expiration date, traders will want to consider interest rate risk. Rho helps us answer the question of whether interest rate paid on a savings account is better than investing in the option. So, yes, traders who buy LEAPS options need to know this. I hope this video gave you a little more insight about LEAPS options. Let me know in the comments below if you have any, trade them, or if you have any questions in general about them, because I love to answer all of your questions. In the meantime, thanks for watching, and I'll see you in the next video. See ya.